Hello and welcome to the Deb Calvert channel on Bright Talk. Here on this channel, we normally talk about people practices and ways that you can put people first. So today's topic might seem at first like it's an outlier, but I really wanted to present this topic because, well, you've been asking me to, but also because this is a great way to put yourself in the shoes of the people in the C-suite or in the finance department, so that when you present your ideas or prepare your budget or defend your expense allocations, that you're looking through the same lens that they are. And that way you can be more effective. We're going to talk about some financial terms. We'll review some basic accounting methods. And all of this is aimed at giving you just a little bit more business acumen so that you can understand their perspectives and you can be aligned with what's important to them as you're presenting your ideas. If you're new to Bright Talk, please note that there's an Attachments and Links tab. I've put today's slides in there for you, and there are a lot of slides today. I strongly recommend that you download that PDF because I'm going to go pretty fast. There's a lot to cover here. You're welcome to download that right now and take some notes as we go. I also attached a glossary of basic financial terminology that I selected out because it will be useful as a reference back after we spend this short little 45 minutes together. If you have any questions for me along the way, please post those in the questions tab. I'll try to answer them as they make sense in the flow of the presentation. If there are any that I don't get to, I'll email you. If you're listening on demand instead of listening live, you're welcome to connect with me over there on LinkedIn and ask me a question anytime. All right, we've got to roll really quickly here, so let's jump in. In business, as you probably already know, money making has three basic parts: cash generation, return on assets, and growth. And there is an interplay between these three parts, so we have to look at them both separately and in relation to each other. I'm going to take them one by one, getting pretty fundamental here intentionally, but again, put yourself in the shoes of people in your finance department or in the C-suite. Think about as you're talking with them, this is the kind of stuff they want you to know and that you'll need to know to be able to be aligned. So cash generation. This includes how money is earned, how much money is earned, and whether or not the amount of money earned is sufficient to make a profit after you take out expenses. Product sales are typically the primary generator of company revenues, and most companies also use credit in addition to receiving cash payments. So what that means is that cash generated and income could be different from each other. And that's why companies have accounts receivables departments. That's keeping track of money that customers or others owe to the company. So cash generation, it can also depend on how much money is going out of the company. That's cash flow. Cash flows out of the company for expenses like all the usual things: salaries, taxes, payments to vendors and suppliers. When the company owes money to others, that's called accounts payable. And the timing of those payments could affect the cash that's available. Obviously, cash is what gives a company the ability to stay in business. It's the company's oxygen supply. A lack of cash, decreasing cash, or overconsumption of cash, spending it faster than you make it, all those things will lead to big financial woes for a company. Now, in any company, this is really important to know even at the front line, every action by every single employee either uses cash or generates cash. For example, a mailroom employee, even a mailroom employee, and every single employee in the place has an impact on cash generation. So let me give you an example. Let's say this mailroom employee receives mail on Friday morning, but the employee doesn't sort and deliver the mail until late on Friday afternoon. The checks that arrived in that morning's mail now don't make it to the accounts receivable team until they're nearly ready to go home, so they don't process the payments until Monday, which delays by at least 56 hours when the checks will turn into cash. And that means that there's less interest that income can generate for the company. Enough of those kinds of situations add up to significant cash that's lost because it's not flowing through the organization in a timely manner. But the thing is, most employees, they have no idea. They don't understand how their actions impact the company's cash and subsequently the company's financial health. So a best practice for managers in all departments is to help develop this kind of business acumen for all employees so they know what impact they're having. Okay, the second building block of money making is the return on assets, the ROA. And there are two types of assets. When you hear about tangible assets, that refers to things like, anything that's physical, like a production plant, the office building, office equipment, and furniture. These large items are sometimes referred to as fixed assets. On the other hand, intangible assets include things like your knowledge base, your experience base. Because the company has invested in all these assets, there's an expectation that those investments are going to yield a return at some point. Over time, there has to be a return on assets that covers the initial cost and then some. You want to make money, not just break even. The whole point of obtaining those assets was to increase the amount of cash generation or how quickly you generated the cash, the velocity of the cash generation. Any assets that do not contribute to cash generation in some way are generally considered to be a waste. And you certainly want to minimize waste wherever you can. So think of it this way. Every single office supply, every employee hired, every training program, and every project is ultimately intended to increase your sales or to enable you to make more sales more quickly. And although the sales division is responsible for generating most of the revenue, every department that produces a product or operationally keeps the business running also plays a role in achieving this return on assets. Managing expenses, putting out a quality product, enhancing the company's image, serving customers, creating a positive work environment, all of these contribute to an improved return on assets. And that might be important for you to know because somehow your job plays a role in the return on assets. And to know your own value to the company, you might want to understand that piece of it. The faster work is done and the faster sales are made, the higher the return on assets. As I mentioned a moment ago, that's called velocity. And it's sometimes overlooked because companies tend to focus primarily on the profit margin. But a low margin with a high velocity can generate more cash, in some cases, than a high profit margin with a low velocity. And that's why productivity is an important business metric. Now, I realize I'm going through this pretty quick. These are just the basics. You can always come back and listen to this recording again. It will be available on demand. Be sure and download the slides and the glossary, and notice that I've put in a couple of other places where you can go to get some additional learning. Okay, let's talk about the third building block. It's growth. When there's low growth, progress suffers. Costs are cut, employee numbers are thinned, future-focused activities like research and development are neglected. Without growth, a company loses talented people and it loses competitive advantages and market share and the ability to innovate and lead. Growth has an ability to energize a business and to attract customers and to inspire employees. So you want the company to be healthy and growing, and when it is, you certainly want to tell that story to everybody inside your organization. When there is growth, though, it's best for it to be profitable and sustainable. And the only way to get profitable, sustainable growth is if you have good profit margins and the right velocity of your sales. Your cash generation has to keep pace with your growth. Sometimes senior management inadvertently, they don't mean to, but sometimes they encourage unprofitable growth by giving, for example, they might give the sales force the wrong incentives. Sales of some products can be more costly than others, which is why not all sales are created equal. Focusing on growth without understanding these other building blocks can be problematic. See, some growth generates cash, and some growth consumes cash. So making more sales is not as effective as making the most profitable sales. No growth happens, of course, without customers. Without customers' trust and loyalty, it's really difficult to grow. If customers don't see the value in the products or services that your company offers, then your potential for growth is impaired. So all these factors, as I said, there's interplay between them. But for now, let's just rest on the fact that these are the building blocks, and if you don't take anything else away from this webinar, you've got a good start here. Okay, but now that we have talked about the building blocks, I want to spend some time on how these building blocks are showing up in financial reporting. That way, if you ever look at the various reports, you'll have an idea of what you're looking at. When companies report on their finances, they talk in this language. They talk about their assets and their liabilities, and all companies have them. Assets represent anything at all with a monetary value. Cash itself is an asset. Money or services that are to be received are included in assets. Incoming and anticipated assets, the ones that come from sales and the delivery of services to you, plus any interest income, all of that is referred to as revenue. All the incoming money is referred to as revenue. Revenue rolls up into the assets because it has monetary value. On the other hand, liabilities are the debts or expenses that are going to be paid to other parties. That includes the salaries and the benefits paid to your employees. It includes the cost of the raw materials that you use to produce your goods. It includes office supplies and business travel and software systems and all of the other things that it takes to operate your business. I've got one more term here, and that's equity. Equity is one you don't hear about as often, but it refers to the owner's share of the assets in the business. So equity, that's the company's total assets minus the company's total liabilities. A successful company has more assets than it does liabilities, meaning it has the resources it needs to fulfill its financial obligations. Any company that has liabilities that exceed its assets, well, that's a company with no equity, and it's in financial trouble. It's probably not going to be able to survive for long. When you take this information and you calculate it, there are three different ways primarily that you see this presented. The first one is the balance sheet. Whenever you look at a balance sheet, this is pretty standard, the assets appear on the left-hand side and the liabilities appear on the right-hand side, and they're side by side As opposed to being in a vertical presentation, they're side by side so that you can see them and compare them very quickly. Most balance sheets will show a breakdown of assets and liabilities. They're going to be in a line item format, side by side. And these are usually classified into predetermined groupings. So here's what it might look like. This is a sample balance sheet. What you're looking at here, this balance sheet shows groupings or categories like current assets in this case, separated from intangible assets. Remember, those are our assets on the left. And over on the right-hand side, you see the liabilities. They've, in this case, separated current liabilities from long-term liabilities. Different companies bucket their categories in different ways. But whenever you have divisions in an organization, or if you've got a parent company with multiple entities, or you have two organizations that merge, they generally strive, the finance department will get them to a place where they're using the same buckets. They're grouping things in the same way. They're classifying their assets and their liabilities in the same way across all those properties and divisions. That just helps the parent company to get an accurate picture of comparisons. And then, of course, also a much easier way to roll up the data so that they can report as the parent company to their shareholders or ownership or others who have an interest in that. Typically, a balance sheet is used to get a snapshot of the company's financial position at just one little specific point in time. At any given moment, it shows what the company owns and what the company owes, plus the amount invested by the shareholders. So that's why it gets updated all the time, and it's used by investors and by creditors or bankers to see how effectively a company's management is using their resources. This financial report gets distributed to everybody, the lenders, the investors, and anybody with a stake in the company's financial health. One that you might see more often is the P&L statement, the profit and loss statement, often called an income statement. This is a financial statement that summarizes the revenues, costs, and expenses during a period of time. It's usually a fiscal period, like a quarter or an entire year, so a 3-month period or a 12-month period. And this statement, it's showing the company's ability, or its lack of ability, as the case might be, to generate profit by increasing revenue or by reducing expenses or by doing both. It's called a P&L statement or an income statement because it focuses on what needs to be done going forward to improve the profitability of the organization. So the P&L, it provides the top line and the bottom line for a company. Anytime you hear the term top line, that's referring to the incoming revenue. The bottom line refers to the profit. The profit is not the same as the top line because what's in between the top and the bottom line are the business expenses. So you subtract all of those business expenses from the incoming revenue to see the bottom line, the profit, also called the net income or the earnings. Lots of terminology for what's down there at the bottom line, but those are all synonymous. Profit line, profit margin, bottom line, net income, earnings, they're all essentially the same when they're used in that way. In accounting, it is a standard practice to add information to the P&L when the revenue or expenses are incurred, not when the money flows in or out. So accounting's P&L statement will probably be more timely. It'll be more like the one that we looked at here just a moment ago where we had things side by side, the balance sheet. Accounting sort of runs those in tandem with each other, but what gets posted and publicly consumed is not timely. It's the period of time being represented. Okay, so you'll see here that we no longer have things side by side. Now it's being presented vertically. And in this sample P&L statement, we've got a couple of things of note. Right at the top there, as you'd expect, you see the total revenue. That's the total amount of money that was generated by the company. Right underneath that, on this particular P&L statement, we have the cost of goods sold being deducted separately from all the other operating expenses. And that's a fairly common practice. The cost of goods sold comes underneath the total revenue of $1 million. And then when you take out the cost of goods sold, there's a gross profit different from the net profit there at the bottom. If you hear gross profit, it's because there's this extra step showing the total revenue minus the cost of the goods that were sold. And the cost of goods sold, that includes any materials, raw materials that were used to create what you sell, along with any labor costs directly related to producing the goods. So that means that certain other kinds of fees are not included in the cost of goods sold. For example, you'll notice later, way down towards the bottom, wages and salaries. That would be wages and salaries for people like the folks in HR who are not directly involved in the cost of goods sold here at the top. So that this is sometimes used in companies that separate it. Not all companies do that. But I just wanted to show you one, so in case you had that extra line in there, you knew what it was all about. If this particular P&L did not include a gross profit line, you'd just see the line item expenses going straight down without a differentiation between what was attributed to the production of goods and what was not. But either way, the cost of goods sold and all the operating expenses, they all get deducted from the top line revenue so that you get to your bottom line or your net profit. Okay, the differences, you might be wondering at this point, what are the differences then between the P&L statement and the balance sheet? Let me recap those differences. It is all a little bit confusing. The balance sheet, that's the one that has it side by side, the assets and liabilities, and the P&L statement that goes in a vertical formatting, they might seem really similar, and they do contain a lot of the same information. It might seem like there's a lot of duplicated work. So let's talk about the differences and how these are used. So first of all, the balance sheet, it is always constantly being updated. And it can show at any moment in time, it can show the exact and actual accounting of assets and liabilities. It's a ledger, and it's regularly updated, often in live time. But the P&L statement looks at a period of time like an entire fiscal quarter. The second difference is the purpose that these two reports are meant to serve. The balance sheet is used to report a long-term picture of what's going on with investments and debts. It portrays how those three major accounts of assets, liabilities, and shareholders' equity are balancing each other out. But the purpose of the P&L statement is to report whether or not, in a specific time period, the company has been profitable. It's also used to monitor incoming revenue and outgoing expenses so the company can react. The company can be reacting to ensure that that bottom line profit will be achieved. If it looks like in a particular quarter that the expenses are high compared to the amount of revenue, then the company knows they need to either increase revenue or decrease expenses or both. It's the P&L statement that informs them in that way. The third difference between these two reports is what's been calculated and what's being shown. In simple terms, the balance sheet is used to show the company's total value, and the P&L statement is used to show whether the company is in the red or in the black. Of course, these two reports, they're also used together. When they're used together, it's to assess the company's operational efficiency, and it's year-over-year performance, and its organizational direction. The numbers all together help the executive team and the board to make decisions going forward. And that's why these numbers are scrutinized by investors and executives. Okay, one more report about a company's financial picture that we need to talk about, and that's called the cash flow statement. The cash flow statement reports any cash inflow or outflow over the course of the accounting period. An accounting period might be a month long, could be a week long, depends on what's going on in your organization and how it's set up. This financial statement, any financial statement, highlights, cash flow statement rather, highlights the net increase and the decrease in total cash on hand for the accounting period. So for that period of time, that week or month, how much cash is on hand? And the cash flow statement, it gets broken into different sections. Those sections are usually operating, investment, and financing activities. It's showing the amount of cash and the cash equivalents that are entering and leaving the company's coffers. This is measuring how well a company manages and generates cash to pay its debt, to take care of its obligations, to meet its operating expenses. To determine cash flow, the net profit reported on the P&L statement, that's the bottom line, that's the starting point. And then three sources that generate cash are factored into that. So we start with the current bottom line, and then factor in these three sources. The first thing that's factored in is cash that comes from operating activities. So that's basically how much cash is generated from the sale of your goods and services, any changes in accounts receivable and in accounts payable and inventory, all that's included here. The cash flow from capital expenditures and long-term investments gets excluded from this report because those are not day-to-day activities. Those are unusual. They're not business as usual. And this is one of the differences between operating activities that you see on the cash flow statement and what's reported as expenses over on the P&L or the balance sheet. So some things are isolated off of this report. The second source that's considered here is cash from any investing activities, like if you sold some assets, big ones, like a building, or if you had cash that resulted from a merger or an acquisition. And the third source of cash that's factored in is from any financing activities. So if you've got investor and bank activities like the payment of dividends or repayment of loans, then that also gets umbrellaed here. The cash flow statement shows how the changes in the balance sheet and the income on the P&L statement affect the company's cash position. So we're measuring the flow of cash in and out of the business. And that's also important to know, especially if you're considering any major investments or changes or any ways of changing the way you do business going forward. Here's another sample for you. As I said, the starting point up there at the top, it's the net income. That would be an exact match to the bottom line on the P&L statement. And note, too, that those three sources I mentioned, the sources that generate cash, they're categorized here, they're circled. That's the day-to-day operating activities, the investing activities, and the financing activities. Sometimes the cash totals in a category are going to show a positive number, and sometimes it's going to be a negative number. That's what the minus signs are all about. But at the bottom, the net cash number, that's the sum of the totals in each category. So it's totaled up in each category, and then at the bottom, you see the sum total. Okay, the reason that cash flow is reported separately is that a company can be unprofitable but show positive cash flow, and vice versa. A company can be profitable but show a current negative cash flow. So it's just one more way of looking at the organizational health It gives you insight into the company's strategies that might need to be considered for improving cash flow, things like, reducing the number of days to collect on accounts receivable. So those are the three reports. These are reports used to look at the finances in the past or present state. And now we're going to look at something else, financial reports that are looking at the future. And these are heavily influenced by the ones we've just reviewed. These are the ones, though, that you might have a little bit more familiarity with, a little bit more input into. A budget, obviously, that's a formal statement of the management team's plans for the future. It's just written in financial terms. A manager uses a budget to plan and to control expenses. And budgets are also used to establish goals for future operations. They're basically a tool for decision making, and they can be used as a way to measure business performance. Most budgets set goals for specific periods of time, annually, quarterly, monthly. And, there are different kinds of budgets used by different functional areas of the company, but each one of those budgets, it cascades from and it supports the company's master budget. So there's a master budget way up at the top of the organization. Every division has something cascading, their own budget. For example, the sales budget is going to predict the quantity or the volume that's expected to be sold in a specific time period. And then usually that gets broken down even further by sales team or even by individual seller. The budgeted amount is based on an analysis of previous sales and estimates of potential future sales, depending on what's going on in the marketplace. Any area or any special initiative might also have a project budget. That's an add-on to what's typically budgeted. It might cross multiple departments, and that's why it gets separated out so it doesn't have a direct impact on any one division. Here's a sample budget for you. It is built by first determining a target profit margin, then declaring the fixed costs, estimating the costs that aren't fixed, the ones that are subject to a lot of variability, and then realistically forecasting the revenue. Budgets include line item allocations for both income and expenses. So you see them all in there, revenue at the top and then expenses, because we need to look at the bottom line, taking the revenue and subtracting out the expenses. Most companies compare budget numbers year over year, and they also compare actual numbers to budget numbers in each time period. And then managers, they're usually held accountable to administering their own portion of the budget with an expectation that they deliver revenue promised and that they do not exceed budgeted expenses. So let's look at some of the inputs that are used in budgeting. You've got, for example, the sales forecast. Accurate sales forecasting helps the organization to plan ahead so they can make investments or they can make expense cuts. They can do whatever they need to do to meet their desired profit margin. It's that bottom line that's driving so many of these decisions. Strategies for growing revenue are based on identifying areas of potential demand, going out there and analyzing the competitive landscape to see where the opportunities might be. You might also look at historical data and trends to model what future growth is most likely to look like. Setting an appropriate growth rate, that's going to be based on expectations about product price and future unit sales. You might also take into account penetrating into new markets, increasing market share by stealing the share from competitors. Maybe there's some analysis about the industry outlook, the key product features that you might be adding. There will be a lot that goes into the sales forecast. In publicly held companies, revenue forecasts are also calculated by analysts. And so these are really, really crucial because they have a factor in setting expected stock prices. If you don't have an accurate forecast, determinations about whether to buy or sell stock can't be made. It would be complete guesswork. So all these different models exist for revenue forecasting. What you see on screen is actually a relatively simple model. I've mentioned a few times the shareholder, and I think it's important to talk about the shareholder because they're one of the groups of people who care the most about all this stuff. A shareholder or a stockholder, that's any person, any company, any institution that owns at least one share of a company's stock. Because shareholders are a company's owners, they reap the benefits of the company's success in the form of increased stock valuation. But if the company does poorly and the price of its stock declines, shareholders lose money. So that's why legally shareholders have the right to inspect the company's books and records at any time, and they receive a portion of any dividends the company declares. They also attend annual meetings to learn about the company's performance, and they vote on major decisions about the company's future. In other words, shareholders have a vested interest in the financial performance and health of the organization. And that's why every business is expected to earn a return that's greater than the cost of the money that's been invested by the shareholders. Shareholders, they always want a company to maximize its returns and to pay bigger dividends and to show healthier profits. When companies fail to do that, shareholders demand changes in the executive ranks. People's jobs are lost if they don't post healthy financial performance. Or shareholders might sell their shares, and that pushes stock prices down. It diminishes the value of the company. That also significantly impacts the folks in the executive ranks because a significant portion of their pay is wrapped up in their shares that they might hold. So that's why companies are careful about what they report to shareholders, and they're also very thoughtful about how they tell their story about their profitability and their financial performance. I'm going to give you just a few ideas here about how companies do tell that story. Some companies, this has become very fashionable, some companies like to report on their EBITDA. That word stands for earnings before interest, taxes, depreciation, and amortization. So I'm going to give you just a quick whirl through those words. Remember, you've got a glossary that will take you deeper. Interest is any income that a business earns from its various investments. Taxes, obviously taxes are any of the obligations owed by the company to the Internal Revenue Service here in the U.S. Depreciation and amortization, both of those reduce the costs of assets that are held by the business over time. When you take those all out of the equation, EBITDA gives investors a good idea of how a company is doing financially. It shows how much cash a recently reorganized or restructured or newly acquired company might need to generate before it can pay off its debts. Using EBITDA as a metric, it will show higher profits rather than simply providing operating profits because all these other factors have been taken out. You're most likely to see EBITDA being used as a measure when there are some sort of buyouts. Certain sectors or industries use this more than others. It's also popular in industries that have expensive assets that have to be paid down over long, long periods of time. One common misperception about EBITDA is that it's a representation of cash earnings, and that's not true. It doesn't reflect cash flow. It does give insights into profitability, and some would say it's a technique used to pump up the way a company's earnings are positioned. So most investors, they'll either use additional metrics when a company favors EBITDA as the standard way that they want to be measured, or they'll require different reporting altogether. So EBITDA, as I said, doesn't satisfy all shareholders. They may want to know more about these other measures of profitability. Companies might tell their financial story by talking about these 4 metrics. I'm just going to go through them very, very quickly here. Cash flow, that's the measure of performance and profitability in some cases. When you call it by a different name, distributable cash flow, this is very popular in Canada as a substitute for reporting actual earnings. The concept here, it's that not all cash is free-flowing, and as a result, it shouldn't be reported as if it is. So there's some variability in how those calculations are done, and it's just important to know which model you're looking at. Looking at operating income, that's income before interest and income taxes, and before non-operating income like investments in other companies, it excludes some, but not all, of the variables from EBITDA. And then adjusted net income, well, remember, net income, that's the bottom line on the P&L statement. Some would say it should speak for itself and not be adjusted, but there are some merits to reporting that smooths out the highly variable numbers that aren't going to be recurring. The premise here is that one-time or unusual expenses or unusual revenue impacts should be set aside so investors aren't swayed by those numbers. It's not an apples-to-apples comparison. That's the main thing I want you to take away from this. You want to know what it is that you're looking at. Now, from all these numbers, what eventually lands on your desk is that there are key performance indicators. You could call them by a number of names. The things that are tracking your performance in terms of expense management, in terms of revenue generated, right? There are financial performance indicators that you're tracking to show how you and your team contribute to cash generation or return on assets or company growth. And you can be proactive if you keep your eyes on the KPIs and you know which ones have an impact on revenue and on that bottom line, then you have an opportunity to be speaking the language that the C-suite is speaking. If you are looking at these kinds of KPIs, if you're held accountable for anything like this, what that means is that your job, in somebody's eyes, has a direct impact on the financials of the company. If any of these KPIs look familiar for you, expenses versus budget, or cost of goods sold, or top-line revenue like you might see in the sales department, right? You have a direct impact on the finance of the business. You have KPIs that are finance-related. You might have these kinds of KPIs. These are related to customers because, remember, customers are such an important factor in growth. And that building block of business success hinges on customer satisfaction and loyalty. For you, depending on the kind of work you do, customers could be any number of different people who interact with your business. If you work exclusively with employees of the company and you don't produce work that ends up in the hands of people outside your building, then your customers might just be company employees. Everybody has some sort of customer group that they serve. You can contribute to the company's financial health by looking at the KPIs that measure the rate of customer retention, that look at the number of customers that you have, about how fast customer complaints get resolved, about what you do to equip the people who are responsible for customer retention and satisfaction. Some KPIs are all about quality of the product, quality and satisfaction when it comes to the customer, quality that gets measured by how safe people inside your organization are, or what your company image is out there in the public. And lastly, there are some KPIs that are very much people-related. If you are in HR or if you're a frontline manager, you ought to have KPIs like these. They do make a big impact on the financial health of the organization, but sometimes they get forgotten or sidelined. sometimes people forget how every single one of these KPIs does, in fact, have an impact on the company's ability to generate revenue, to grow, and to post a profit. So you ought to think about that. Whatever your role, think about your KPIs and how they have an impact on the finances we've talked about. Okay, I'm going to leave you with these questions. I hope you're printing out the slides that I prepared for you, the PDF that you can download. And these are the questions to ask yourself. Download the glossary, think about what we've talked about here, and ask yourself these questions so that you can get connected into the finances of the organization, so that you can have discussions that are higher level and more strategic, and that you're looking through the same lens as the folks in the C-suite do. I know we took a whirlwind tour here. I think I've addressed all the questions that were posted along the way. If you have questions later, or if you're coming into this on demand, don't hesitate to reach me. LinkedIn is a great place to connect with me. And if you aren't already, subscribe to this channel. We're doing all kinds of webinars, putting out a lot of content here and on our website that is meant to help you put people first in all the work that you do. Thanks very much for attending. Please leave me a review so that I know what to do differently in the future.